Hi, and welcome to Module 5, Long-Term Insurance Advice. Let's dive in. In this module, we cover the following topics. Learning Unit 1, Products of the Long-Term Insurance Industry. Learning Unit 2, the Long-Term Insurance Act 52 of 1998. Learning Unit 3, Disability Insurance. Learning Unit 4, Fraud in the Long-Term Insurance Industry. Learning Unit 5, Role players in the long-term insurance environment, and Learning Unit 6, Products of the Issue of Abnormal Risk. 135. Learning Unit 1, The Purpose of Long-Term Insurance. Long-term insurance provides financial protection over an extended period, typically for life or a specified term. The main purposes include financial security, to provide financial support to beneficiaries after the policyholder's death. Wealth preservation helps in estate planning by ensuring liquidity for estate taxes and debts. Income replacement provides a steady income stream in case of disability or retirement. Investment. Some long-term policies have an investment component that can grow over time. The types of long-term insurance. In South Africa, long-term insurance can be categorized into life insurance, pays out a lump sum on the death of the policyholder. Disability insurance provides income replacement if the policyholder is unable to work due to disability. Critical illness cover pays out on diagnosis of a critical illness like cancer or heart disease. Income protection ensures a continuous income if the policyholder is unable to work. Term insurance. Term insurance is a straightforward life insurance product that provides coverage for a specified period. If the policyholder dies within this term, a death benefit is paid to the beneficiaries. Example in South Africa, Discovery Life, Classic Life Plan, offers term life cover with optional benefits like severe illness and disability cover. The term can range from 5 to 40 years. Conventional life insurance products. These are traditional life insurance products with a savings element, combining protection with a cash value component that grows over time. Example in South Africa, Old Mutual Greenlight offers life cover with an investment component. Policyholders can choose additional cover for disability and critical illness. Universal life products. Universal life insurance is a flexible premium life insurance product that separates the savings and protection components. Policyholders can adjust their premiums and death benefits. Example in South Africa, Sanlam Universal Life Plan offers flexibility in premiums and coverage. It combines life insurance with investment options, allowing policyholders to grow their savings. Recent developments in product innovations. Recent innovations in the South African insurance market include Insurtech, digital platforms for easier policy management. Customized policies, tailored insurance solutions based on lifestyle and needs. Usage-based insurance, premiums based on actual usage or behavior. Example, Discovery Vitality, integrates health and lifestyle data to offer personalized premiums and rewards for healthy behavior. Retirement annuities. Retirement annuities, RAs, are investment products designed to provide a steady income during retirement. They offer tax benefits on contributions, making them a popular choice for retirement planning. Example in South Africa, Allan Gray Retirement Annuity allows individuals to save for retirement with the benefit of tax deductions on contributions and a variety of investment options. Investment-linked products. These products combine life insurance with investment opportunities. The returns are linked to the performance of the underlying investments. Example in South Africa, Liberty Linked Life Annuity provides life cover with investment options in equities, bonds, and other assets, allowing for potential growth based on market performance. Supplementary benefits. Supplementary benefits, also known as riders, are additional coverages that can be added to a primary insurance policy for enhanced protection. Examples in South Africa, Waiver of Premium Rider waives future premiums if the policyholder becomes disabled. Accidental Death Benefit provides an additional payout if the policyholder dies due to an accident. Critical Illness Rider offers a lump sum payment upon diagnosis of a critical illness. In summary, long-term insurance in South Africa offers a range of products designed to provide financial security, investment opportunities, and protection against unforeseen events. Each product type has unique features and benefits tailored to meet the diverse needs of policyholders. Learn in Unit 2, the Long-Term Insurance Act 52 of 1998. The Long-Term Insurance Act 52 of 1998 regulates long-term insurance business in South Africa. It provides a legal framework to ensure the protection of policyholders and the stability of the insurance industry. Regulation of insurance business. Insurance business in South Africa is regulated to maintain industry stability, protect policyholders, and ensure fair practices. Regulatory measures include licensing and supervision. Insurers must be licensed and are supervised by the Financial Sector Conduct Authority, FSCA. Capital requirements. Insurers must maintain adequate capital to meet their obligations. Consumer protection. Regulations ensure that consumers are treated fairly and are well informed about their policies. Solvency and reporting. Insurers are required to adhere to solvency standards and regular reporting to the regulatory authority. The acts that govern insurance and an explanation of why there is more than one act. South African insurance is governed by multiple acts to address the different facets of insurance. Long-Term Insurance Act 52 of 1998 governs life insurance, disability, and other long-term policies. Short-Term Insurance Act 53 of 1998 governs short-term insurance such as property, casualty, and vehicle insurance. Multiple acts exist to distinctly manage the diverse nature of long-term and short-term insurance, reflecting the differing risk profiles, policy structures, and regulatory requirements of each. The Short-Term and Long-Term Acts. Short-Term Insurance Act 53 of 1998 covers non-life insurance products like motor, household, and commercial insurance. It regulates the conduct of short-term insurers and protects policyholders from the risks associated with non-life insurance. Long-Term Insurance Act 52 of 1998 focuses on life insurance and investment-linked products. It aims to safeguard policyholders' interests, ensure financial stability, and promote confidence in the long-term insurance market. The Long-Term Insurance Act. The Long-Term Insurance Act 52 of 1998 includes provisions related to policyholder protection rules, PPRs, set standards for the fair treatment of policyholders. Disclosure requirements ensures transparency by mandating insurers to provide clear and comprehensive information. Market conduct regulates the behavior of insurers to maintain market integrity. Complaints resolution establishes mechanisms for resolving disputes between insurers and policyholders. The different classes of policies. The Act defines several classes of policies. Life policies provide death benefits or savings components. Health policies cover medical expenses and critical illnesses. The disability policies offer benefits if the policyholder becomes disabled. Fund policies, investment-linked policies that grow with market performance. The parties to a long-term insurance contract. Insurer, the company providing the insurance coverage. Policyholder, the individual or entity purchasing the insurance. Life assured, the person whose life is insured. Beneficiary, the person or entity designated to receive the policy benefits. Insuring the lives of children. The Act allows for the insurance of children's lives with specific provisions to protect their interests. Policies can be taken out by parents or guardians, typically for future financial security or education funding. Life contracts and/or other contracts. Life contracts. These are life insurance policies that provide a benefit upon the death of the life assured. Other contracts include annuities, disability cover, and investment-linked policies. These contracts may offer benefits during the policyholder's lifetime, depending on the terms. The life insurance contract and insolvency. In the event of insolvency, life insurance contracts are generally protected to ensure that beneficiaries still receive the policy benefits. The Act includes provisions to safeguard these contracts from being used to settle the policyholder's debts. The Four Funds approach. This approach requires insurers to segregate their business into four distinct funds for Policyholders Guaranteed Fund, ensures guaranteed benefits are secured. Policyholders Non-Guaranteed Fund, deals with discretionary benefits. Shareholders Fund pertain to the insurer's equity and profit. Unallocated surplus fund manages any surplus not yet allocated. This segregation helps in maintaining financial integrity, ensuring that policyholder benefits are protected and appropriately managed. Learning Unit 3, Disability Insurance. Disability insurance is designed to provide financial support in the event that an individual becomes unable to work due to a disability. This unit explores various aspects of disability insurance, including its purpose, types, and recent industry developments, with a focus on the South African context. Concept of disability insurance. Disability insurance offers a payout or income replacement when a policyholder is unable to work due to illness or injury. It aims to cover the loss of earnings and provide financial stability during the period of disability. There are different types of disability insurance. The short-term disability insurance covers temporary disabilities and typically pays benefits for a few months up to a year. Long-term disability insurance provides benefits for more extended periods, potentially until retirement age if the disability persists. The purpose of disability insurance. The primary purposes of disability insurance include income replacement, ensures that individuals continue to receive an income when they are unable to work due to disability. Financial stability, helps maintain the policyholder's standard of living and meet financial obligations such as mortgages and education expenses. Peace of mind, provides reassurance that financial needs will be met even if the policyholder cannot earn an income. Physical impairment. Physical impairment refers to the loss of physical function or capacity due to injury or illness. Disability insurance policies often cover various degrees of physical impairment, which can be categorized as total disability, the inability to perform any work; partial disability, the ability to perform some, but not all, work-related tasks; permanent disability, long-lasting or irreversible impairments that prevent the individual from working. Freestanding disability versus linked disability cover. Freestanding disability cover. This is an independent policy specifically for disability insurance. It provides coverage solely for disability without being tied to other insurance products. Example in South Africa, Old Mutual's disability cover, a standalone policy providing benefits if the policyholder becomes disabled and cannot work. Linked disability cover. This type of cover is attached to another insurance policy, such as life insurance. The disability benefit is included as an additional feature. Example in South Africa, Discovery Life's Life. Cover with severe illness. Benefit combines life insurance with disability and critical illness cover. Income generation for the disabled. Disability insurance ensures a steady income stream for disabled individuals, helping them manage daily expenses and financial commitments. Besides insurance payouts, individuals might consider other income generation methods. Remote work. Many disabled individuals can work from home in various capacities, depending on their skills and the nature of their impairment. Freelancing. Leveraging skills for freelance opportunities can provide flexible income options. Industry developments, traditional versus innovation. The disability insurance industry has seen significant advancements. Traditional insurance relies on established methods of underwriting and policy structure, often with rigid terms. Example, Sanlam Disability Insurance, a traditional policy offering comprehensive disability cover. Innovative approaches. Modern innovations include digital platforms for easy policy management, customized coverage based on lifestyle, and dynamic underwriting practices. Example, Hollard, My Life, an innovative approach with customizable cover options and digital management tools. Occupation and avocation risks and cover. Disability insurance policies assess risks associated with the policyholder's occupation and avocations, hobbies. High-risk occupations or dangerous hobbies may lead to higher premiums or exclusions. Occupation risks. Jobs involving manual labor or hazardous conditions pose a higher risk of injury and disability. Avocation risks. Activities such as extreme sports or high-risk hobbies can affect the terms and cost of disability insurance. Example, occupation-specific cover. Insurance for high-risk professions like mining or construction often comes with tailored benefits and premiums. Holistic financial planning. Holistic financial planning involves integrating disability insurance into a comprehensive financial strategy. This includes emergency savings, ensuring there is an emergency fund to cover short-term needs before insurance benefits kick in. Retirement planning, considering the impact of a potential disability on retirement savings and income. Example in South Africa, financial advisors. Many insurers offer advisory services to help integrate disability cover into broader financial plans, ensuring comprehensive protection and financial stability. Learning Unit 4, Fraud in the long-term insurance industry. Fraud in the long-term insurance industry poses significant risk to insurers and policyholders. Understanding the various aspects of fraud, including its forms, indicators, legal considerations, investigation methods, trends, and control mechanisms is crucial for maintaining industry integrity and trust. Concept of fraud. Fraud in the insurance industry involves intentional deception or misrepresentation by individuals or groups to obtain financial gain unlawfully. This can include submitting false claims, providing incorrect information, or manipulating policy terms to benefit unjustly. Forms of fraud. Fraud in the long-term insurance industry can take various forms. Application fraud. Providing false information on insurance applications, such as lying about age, health status, or income. Claims fraud, submitting fraudulent claims to receive payouts. This includes exaggerating injuries, fabricating incidents, or forging documents. Premium diversion, agents or brokers embezzling premiums paid by policyholders instead of forwarding them to the insurance company. False beneficiary claims, listing non-existent or ineligible beneficiaries to collect insurance payouts. Impersonation, fraudsters pretending to be someone else to claim benefits or modify policy details. Indicators of fraud. Certain red flags can indicate potential fraud in insurance claims and applications. Inconsistent information, discrepancies between the information provided and actual facts. Unusual claim patterns, frequent claims shortly after policy inception or just before policy lapses. High-value claims, claims for substantial amounts, especially if circumstances are questionable. Pressure for quick settlement, insistent demands for expedited claim processing. Altered documents, suspicious or tampered documents submitted as part of the claim process. Legal aspects. Legal frameworks and regulations address fraud in the long-term insurance industry to protect consumers and maintain market integrity. Insurance Act provides guidelines for fair practices and penalties for fraudulent activities. Fraud prevention legislation. Laws such as the Prevention and Combating of Corrupt Activities Act, PRECA, criminalize fraudulent acts and impose severe penalties. Contract law. Insurance contracts contain clauses that allow insurers to deny claims or terminate policies if fraud is detected. Investigating fraud. Investigating insurance fraud involves several steps. Initial assessment, reviewing the claim or application for any red flags or inconsistencies. Detailed investigation, gathering evidence, interviewing involved parties and analyzing documents. Collaboration with authorities, working with law enforcement agencies and regulatory bodies to address fraudulent activities. Forensic analysis, employing forensic accountants and experts to trace financial irregularities and verify claim legitimacy. Reporting and action, documenting findings and taking appropriate legal or administrative action against fraudsters. Fraud trends. Recent trends in insurance fraud include digital fraud, increasing use of digital channels for fraud, such as online application fraud and cyber attacks on insurance databases. Organized crime, syndicates engaging in large-scale, coordinated fraud schemes. Identity theft, fraudsters using stolen identities to purchase policies or file claims. Medical fraud, involving healthcare providers in submitting false medical claims or inflating treatment costs. Control mechanisms. Effective control mechanisms to prevent and detect fraud include robust verification processes, thoroughly verifying application information and claim details. Advanced data analytics, utilizing big data and AI to identify patterns and anomalies indicative of fraud. Employee training, educating employees on fraud detection and prevention techniques. Fraud hotlines, providing anonymous reporting channels for suspected fraud. Regular audits, conducting periodic audits of claims and underwriting processes to identify and address vulnerabilities. Collaboration and information sharing, working with other insurers, industry bodies, and law enforcement to share information on fraud trends and best practices. In summary, fraud in the long-term insurance industry is a multifaceted issue requiring a comprehensive approach to detect, prevent, and address. Understanding the various forms of fraud, recognizing indicators, complying with legal requirements, conducting thorough investigations, staying informed on trends, and implementing robust control mechanisms are essential for maintaining the industry's integrity and protecting stakeholders. Learning Unit 5. Role players in the long-term insurance environment. Understanding the various role players in the long-term insurance industry is crucial for comprehending how policies are developed, assessed, and managed. This unit explores the roles of actuaries, underwriters, claims assessors, reinsurers, and the process of product development. The role of actuaries in long-term insurance. Actuaries are professionals who apply mathematical and statistical methods to assess risk in the insurance industry. Their roles include pricing and reserving. Actuaries calculate the premiums for insurance policies by assessing risk factors and determining the necessary reserves to pay future claims. Risk assessment. They analyze data to predict the likelihood of various insured events and their financial impact. Product development. Actuaries help design new insurance products, ensuring they are financially viable and meet regulatory requirements. Financial reporting. They prepare financial reports that comply with regulatory standards, providing insights into the insurer's financial health. Solvency management. Actuaries ensure that the insurance company maintains sufficient capital to meet its obligations to policyholders. In South Africa, actuaries must adhere to guidelines set by the Actuarial Society of South Africa, ASSA, and work closely with regulatory bodies such as the Financial Sector Conduct Authority, FSCA. Underwriters and their role. Underwriters evaluate insurance applications to determine the risk of insuring a person or entity. Their key responsibilities include risk assessment, evaluating the health, occupation, lifestyle, and other factors of applicants to assess risk levels. Policy pricing, setting appropriate premiums based on the assessed risk to ensure the insurer remains profitable. Policy approval, deciding whether to accept or reject insurance applications and determining the terms and conditions of coverage. Reviewing existing policies, regularly reviewing and adjusting policies based on changes in the insured's risk profile or new information. Example in South Africa, Discovery Health utilizes underwriters to evaluate the health risks of new applicants and existing members, ensuring appropriate coverage and premium levels. Claims assessors and their role. Claims assessors, also known as claims adjusters, are responsible for processing insurance claims and determining the legitimacy and value of each claim. Their duties include claims investigation, reviewing the circumstances of a claim, gathering necessary documentation, and verifying facts. Assessment, evaluating the extent of loss or damage and determining the appropriate payout based on policy terms. Customer interaction, communicating with policyholders to gather information, explain the claims process, and provide updates on claim status. Fraud detection, identifying potential fraudulent claims and conducting further investigations if necessary. Settlement negotiation, working with policyholders and third parties to settle claims fairly and efficiently. Reinsurers and their functions. Reinsurers provide insurance to insurance companies, allowing them to manage risk more effectively. Functions of reinsurers include risk sharing. Reinsurers take on part of the risk from insurers, reducing the potential financial impact of large claims. Capital management. By transferring risk, insurers can free up capital to underwrite more policies or invest in other areas. Stabilizing results. Reinsurance helps smooth out the financial impact of large or unexpected losses, leading to more stable financial results. Expertise and support. Reinsurers offer technical support, risk management expertise, and innovative solutions to their clients. Example in South Africa, Munich Re, a leading reinsurance company providing services to South African insurers, helping them manage large risks and maintain financial stability. How long-term products are developed. The development of long-term insurance products involves several stages. Market research, identifying customer needs, market trends, and regulatory requirements. Product design. Creating a product concept that meets identified needs and is financially viable. This involves actuarial input to set pricing and benefits. Risk assessment. Evaluating the potential risks associated with the product and developing strategies to mitigate them. Regulatory approval. Ensuring the product complies with all regulatory requirements and obtaining necessary approvals from authorities such as the FSCA. Pilot testing. Launching the product on a small scale to test its performance and gather feedback. Marketing and distribution. Developing marketing strategies and distribution channels to promote the product to potential customers. Learning Unit 6, Products of the issue of abnormal risk. Abnormal risk in long-term insurance refers to situations where the risk. This unit explores the implications of non-disclosure, the impact of self-reported ailments, the analysis of long-term insurance applications, and the role of intermediaries in managing abnormal risks. The issue of non-disclosure and abnormal risk. Non-disclosure occurs when an applicant fails to reveal important information that could affect their risk assessment and policy terms. Non-disclosure can be intentional or unintentional, but always poses significant risk to the insurer. Intentional non-disclosure. When an applicant deliberately withholds information to secure more favorable policy terms or lower premiums. An unintentional non-disclosure. When an applicant unknowingly omits relevant information due to misunderstanding or oversight. Impact of non-disclosure. Claims denial. Insurers may deny claims if non-disclosure is discovered, particularly if the withheld information is directly related to the claim. Policy cancellation. Policies may be voided or cancelled if non-disclosure is identified after issuance. Higher premiums. Insurers may impose higher premiums if non-disclosure is detected during the underwriting process. Example in South Africa, Discovery Life emphasizes the importance of full disclosure during the application process to ensure accurate risk assessment and fair policy terms. Self-reported ailments. Self-reported ailments refer to medical conditions or health issues disclosed by applicants during the application process. These disclosures are crucial for accurate risk assessment, but can be prone to inaccuracies. Challenges with self-reported ailments. Inaccuracy. Applicants may underreport or inaccurately describe their health conditions. Lack of medical verification. Without medical records or physician reports, self-reported ailments may not be fully reliable. Underwriting considerations. Medical examinations. Insurers often require medical examinations or reports to verify self-reported ailments. In questionnaires. Detailed health questionnaires can help gather more precise information about an applicant's health status. Follow-up. Insurers may request additional information or follow-up on specific disclosures to ensure accuracy. Example in South Africa, Sanlam utilizes detailed health questionnaires and may require medical tests to verify self-reported ailments and accurately assess risk. Analysis of long-term application for cover. Analyzing long-term insurance applications involves a comprehensive evaluation of various factors to determine the risk profile of the applicant and establish appropriate policy terms. Key factors in application analysis. Health history, reviewing medical records, self-reported ailments, and family medical history. Lifestyle choices. Assessing behaviors such as smoking, alcohol consumption, and recreational drug use. Occupation and hobbies. Evaluating the risk associated with the applicant's job and recreational activities. Financial and personal information, considering the applicant's financial stability and personal circumstances. Steps in application analysis. Initial review. Conduct a preliminary assessment of the application for completeness and initial risk indicators. Detailed underwriting. Perform a thorough review of health, lifestyle, and other risk factors, possibly involving medical exams and reports. Risk classification. Classify the applicant into a risk category to determine appropriate premiums and coverage terms. Final decision. Approve, modify, or decline the application based on the analysis. Example in South Africa, Liberty Life implements a rigorous underwriting process to analyze long-term insurance applications, ensuring accurate risk assessment and fair pricing. Role of intermediary. Intermediaries, such as brokers and financial advisors, play a critical role in the long-term insurance market by bridging the gap between insurers and applicants. They assist in navigating the application process, ensuring full disclosure, and selecting appropriate products. Responsibilities of intermediaries: educating clients, informing applicants about the importance of full disclosure and the implications of non-disclosure. Assisting with applications, helping clients accurately complete application forms and gather necessary documentation. Product selection, advising clients on suitable insurance products based on their risk profile and needs. Ongoing support, providing continuous support and advice throughout the policy term, including during the claims process. Ethical considerations. Transparency, maintaining transparency with clients about policy terms, conditions, and the importance of accurate information. Best interests, acting in the best interest of clients, ensuring they understand their coverage and obligations. Welcome to this head office template. Start your video with this title layout to greet your audience and to introduce your topic. Simply add your content into the placeholder header and subheader.